educated gambler's tool. Higher risk and highest return. Any company that has gone public is split into hundreds, or sometimes thousands of pieces called shares or stocks. They're basically claims of ownership on fractional pieces of company that have gone public and is split into hundreds and sometimes thousands of shares. The value of these pieces are determined by the constantly fluctuating economy. There are many flavors of stocks that represent all industries. There are large cap, mid cap, and small cap stocks. Now a clip to explain stocks with an analogy.
A stock represents partial ownership of a company. When you purchase a stock, you're buying a piece or a share of a company. By owning a share, you own a small fraction of the company's assets and have a claim on its future earnings. There are two ways you can make money by investing in stock. The first is through stock appreciation, when a stock you own goes up in value. If an investor bought the stock at one price and the price went up, the investor could then make money by selling the stock to another investor at the higher price. The second way is through a dividend. This is a periodic payment issued by some stocks. A dividend is a way for a company to give a portion of its earnings to shareholders. Here's an example.
What are bonds? Bonds in their most dumbest down form are a loan to the government. You give them money and they give you an IOU receipt, according to the Boston Associates. And it's a safe bet for the conservative sector of the world. And now, a quick clip to explain it.
Bonds are often viewed as a less risky alternative to stocks and are commonly used to diversify a portfolio. Consider this example. The city of Fairview wants to build a new baseball stadium, so it decides to issue bonds to raise money. Each bond is a loan for $1,000, which Fairview promises to pay back in 10 years. To make this loan more attractive to investors, Fairview will pay an annual interest rate of 5%, which in the bond world is also known as a coupon rate. An investor buys the bond at face value for $1,000. Now let's fast forward. Each year, the city of Fairview pays the investor $50. These regular interest payments continue for the length of the bond, which is 10 years. Once the bond reaches maturity, the investor redeems his bond and Fairview returns his $1,000 principal investment. This bond was a good deal for both the city and our investor. Fairview.
What are stocks? What are bonds? And finally, what are mutual funds? Now, it's a moment we've all been waiting for, mutual funds. And you ask yourself, what are these mutual funds? Well, it's an investment program funded by shareholders that trades in a diversified holdings and personally managed set of investments, stocks, or shares. Now that's a mutual fund.
A mutual fund is a collective investment that pools together the money of a large number of investors to purchase a variety of securities, like stocks or bonds. When you purchase a share in a mutual fund, you have a small stake of all investments included in that fund. Think of a mutual fund like a basket of investments. When you purchase a share in a mutual fund, you are buying one share of this basket, and therefore have a stake in one small fraction of all the investments in that fund.
I can't breathe. Stop.
Oh no. Oh
boy,
dear.
I think she's actually hurt.
Bye. Have a beautiful time.